The topic title is Central Bank Digital Currencies, Challenges and Opportunities. We left it really broad because we have a broad set of perspectives from our speakers, whom I will introduce in just a moment. Let me first tell you why we think this is the right topic to discuss at this time. Central banks around the world are very actively considering whether they should introduce a central bank digital currency, which would be an obligation of the central bank used for payments in the general economy. The European Central Bank, which is, we're delighted to have Dr. Ulrich Bindseil from today, and I'll introduce him properly in a moment, is considering the introduction of a digital euro. China is already about to release a digital euro that it's developed over the last years. And the United States is still considering the costs and benefits. It's not even to the point yet of discussing development of the technology beyond research. And in the United States, the payment system is actually lagging in quality those of Europe and China in terms of efficiency. And so you might think the order is backwards, that the United States might have come first in this area. But the Federal Reserve has not decided what to do. In fact, different governors have different views on this. Vice Chair Quarles just this week gave a speech in which he pointedly called out Christine Lagarde, the president of the European Central Bank, asking why would a CBDC increase financial inclusion if you get it through the banks, and if you have to get it through a bank, why wouldn't you just get a bank account? Another governor of the Federal Reserve, Chris Waller, has said CBDC is a solution in search of a problem. Neither of those two governors see a need for it. Governor Lael Brainerd, on the other hand, is more sanguine about the idea and said she cannot, quote unquote, wrap her head around the idea that the United States would not develop a digital dollar, given the fact that many other central banks are actively developing it. So the US has yet to decide. It's going to release, the Fed will release a paper in the coming days about costs and benefits, but is still far from developing a digital dollar. So this is a very, very active area of discussion. It has impact on financial markets, on the payment system, on banking, on the franchises of banks in the area of deposits, credit cards, and payments generally. It's a big deal. And that's why we called together three of the top experts in the world to speak about this. I mentioned Dr. Ulrich Bindseil. Ulrich is the Director General of Market Infrastructure and Payments at the European Central Bank and the author of Central Banking Before 1800, a Rehabilitation. But beyond being a thought leader on central bank digital currencies and other aspects of central banking, Ulrich is actually doing it. He is running the digital euro project for the ECB, and I'm sure he'll tell us about that. We also have Professor Monika Piazzesi, Stanford University and NBER. She's the Joan Kenny Professor of Economics at Stanford University, and the author of many papers that you're all familiar with, but in particular, the author of Credit Lines, Bank Deposits, or CBDC, Competition and Efficiency in Modern Payment Systems, with Professor Martin Schneider. Our third speaker today is Markus Brunnermeier, the Edwards Sanford Professor of Economics at Princeton University and the director of the Bentheim Center for Finance at Princeton University, and the author of the noted recent book, The Resilient Society. He has also been a thought leader on central bank digital currencies, in part through his paper with Dirk Niepelt on the equivalence of private and public money. So I'm going to turn it over to our three speakers. We've allocated them each 8 minutes sharp. I've told them that I'm a menacing timekeeper. I have my stopwatch out. And then we're going to have a bit of crosstalk, and then we're going to open it up for Q&A from the floor. So Ulrich, would you please lead us off?
Yeah, thank you. Thank you, Darrell, for inviting me and for allowing me even to use a few slides, which I hope you can now see. And so I have basically three questions I will quickly answer. Why CBDC from the ECB perspective? Then say a few words about the project we have formally launched, and briefly something on monetary policy and financial stability dimensions of CBDC. So first, why CBDC according to the ECB? And I think it's very simple. Society and payments gradually digitalize. In some countries, it's very advanced. Sweden is a famous example, China as well. So you have a declining use of cash. Payment is a network activity. At some stage, the whole thing collapses, or cash use can collapse, and then there is basically no central bank money available any longer or used in practice. And the whole construct we have been relying on for now quite a while, the two-layer monetary system in which commercial bank money is supposed to be convertible into central bank money, becomes a rather theoretical construct. So from this perspective, offering CBDC is nothing else than to preserve the current ecosystem, the current monetary system, which has always relied on a mixture between central bank money and commercial bank money, and the convertibility of commercial bank money, which should not be a theoretical concept, or cannot be a theoretical concept. So central banks just move with time, with changes in society, digitalization, and stay in business for policy reasons. And maybe on top of this, one could say tackling sovereignty concerns is a topic in Europe. While Darrell, you said kindly that the Europeans would be more advanced than the Americans in terms of payments. I mean, that's not true for the payment instruments used day by day basis by people, where American companies have been extremely successful in Europe, and have let's say market power, and are, if you extrapolate that into the future, they have growing even market shares also in the newest segments of payment. And if you add to this a perspective of global stablecoins, then there is a sovereignty issue for an activity as important for society as payments is. So now we have launched this digital euro project and an investigation phase. So the ECB has not said we will issue digital euro. That is still open. That decision has not been taken, but a project has been launched. This is the first project I have seen in the ECB which is launched without it having been decided to use a product that is being developed in the project. But this relates to the lead time and the importance of being able to issue CBDC presumably at some point in time. So the investigation phase will last 2 years and will clarify the scope and use cases. And here there are some example of use cases: point of sale, e-commerce, person to person, business to person, online, offline, cross-border payments, programmability. The list of possible use cases is very long, but a project also needs to focus. We cannot, address every use case and have the broadest possible scope. Such a project would be unmanageable. We have to focus on something and deliver something valuable in certain segments, while in the long term, of course, then we can expand further. Then other functional requirements like the form factor, mobile payment, will it be a card? Will it be feasible on a desktop? Privacy, traceability, remuneration, limits, inclusiveness, all sorts of functional requirements you have to set in the investigation phase. Then the distribution model: what is the role of banks or other regulated intermediaries in distributing it? Then the so-called business model. So any a private payment instrument like a card scheme has a so-called business model. Someone pays and sustains the ecosystem, involved delivering services. Like in the case of a card scheme, there's a merchant fee. The merchant fee is used to pay the scheme, to pay the issuer of the cards, and because typically the user doesn't pay. And the question is, how is that translated into CBDC? Or is CBDC just for free? But what would it mean to be for free, have no merchant fee, if all the private payment solutions rely on a merchant fee? Big questions. And then, of course, the question of suitable technical solutions, central account, token, DLT. There are lots of, focus on those questions. But if the word token is used, it can mean so many different things. But definitely the technical solution is also in scope of this investigation phase. And we have, again, if you go deeper and ask yourself, what do you want to exactly do? There are lots of, I would say, deep questions you indeed have to shed light on. Like probably you want to minimize industry investment costs for implementing and supporting the digital euro. You want to not have, you want as a central bank not be too dependent on the industry, because you want it to be a separate product where you can put the parameters as a central bank. And then you want a distinct value proposition also, something that is not, just a little button that you switch on your payment app and then suddenly you pay in central bank money, but probably something which is for the user distinguishable. And at the same time, you don't want to crowd private initiatives. So those are lots of things that you combine them. This will all determine your functional requirement, how you really will design the issue. And that's also part of the investigation phase. Last point I want to cover is the no harm on monetary policy and financial stability. So central banks don't view CBDC as a tool of monetary policy. Certainly, central banks don't want to discontinue banknotes. So there's no consideration whatsoever on, policy space you get at the zero lower bound through CBDC, because you get rid of banknotes. Central banks don't want to get rid of banknotes, so that's not the topic. And central banks also, as far as I can see, don't say ability to put interest on CBDC is an extra policy instrument you could use in an intelligent manner. I think that would overload monetary policy ambitions, and central banks are not really talking about that. And then you have the issue of bank runs, which has been identified, so the financial stability issue. So both together, bring you to that you need, some restrictions. And just to take maybe on monetary policy again, the euro area has a monetary policy stance where AAA short-term government bonds have a yield of minus 60 basis points. So it's totally obvious you cannot offer digital euro unlimited at zero interest rate, because you would immediately tighten your monetary policy stance. Everybody would go into digital euro, and yield level at the short end would jump by 60 basis points. So you need either limits or remuneration, negative remuneration. And one option I had explored also in the working paper is a tiered interest rate approach. You don't want holders to have to pay a negative rate on the first digital euro they hold. So one way to solve this is give them a certain amount which is remunerated never worse than banknotes, so zero, let's say, at the moment. But for higher holdings, treat it like an investment asset, and accept that if your monetary policy stance wants to see short-term AAA debt trading at minus 60 basis points yield, then put the interest rate on large CBDC holdings at, let's say, minus 1% currently, to be quite certain to not interfere with the policy stance. And this also gives you a tool against the bank runs, and it's just a bit more elegant than a limit, which reduces the elasticity of the usage of CBDC. That's all from my side for now. Thank you.
Perfect. Monika, you're up, please.
Thank you very much for having me on this panel. So I wanted to talk about the world in which CBDC will get introduced. So basically, it's a market for liquidity, and we all have liquidity needs that are unpredictable. So with some rate V, these liquidity needs arrive, and if you find yourself in the situation where you want to buy something, you have two ways to pay. currently. You have deposits that you have to hold before you buy something, and then you withdraw these deposits when you need them. Or you can arrange for a credit line with your bank, and you draw down the credit line when you need it. The sellers of goods, they receive deposits after they sell you their items. And so all these payments are arranged currently by banks that provide us deposits and credit lines. So let's assume for the moment that banks are not special for anything else. They're just special for providing us with deposits and credit lines. So I'm taking a liquidity-centric view here of banking. And so what are other frictions in the world? So I think of firms as having balance sheet costs. So they have some costs, kappa, proportional to assets, to the length of their balance sheets. They also face leverage constraints. So banks in particular face leverage constraints. So when they issue deposits, they have to back these deposits with some assets. And so phi here is some maximum leverage constraint that they face. Okay, so if you think about this world that I just described, and you think about how to organize payments in a way that maximizes welfare, you would want to do it with the shortest possible balance sheets to save balance sheet costs. And so how does this work? So suppose the market for liquidity only had deposits. Here are the balance sheets. The buyers hold some deposits that they have at the bank. The bank has to back these deposits with some capital, some assets that it holds. Okay, so this is what happens before the trade. Then now the buyers get a liquidity shock. They want to spend, and so V of them actually spent. That shows up as an asset on the seller side. So these are deposits on the seller side, and nothing happens at the bank level because the bank just now has fewer deposits from buyers and more deposits from sellers. So this involves long balance sheets, including of firms that buy and who are not natural holders of deposits because they face these balance sheet costs. They would rather not save in deposits in some sense. So they're not natural savers. And also you have high precautionary deposit holdings if your liquidity needs are very unpredictable. So if V is small, if you don't know whether you want to spend, you have to hold a lot of deposits before you actually spend. So this world is involved with long balance sheets that are costly. So what happens when you introduce credit lines? Credit lines are a contingent liability that is off balance sheets. So before the trade, you don't see anything on balance sheets. It's just that the buyers have arranged for a credit line with the bank. And so this credit line is L, I'm gonna call this L. And so once the liquidity shock arrives, V buyers will draw down their credit lines and pay for these items with the seller. The seller has no choice. The seller is going to get deposits. And so what happens at the bank level is that the buyers, by withdrawing, drawing down their credit line, create an asset for the bank that becomes an asset, and the deposit of the seller becomes a liability of the bank. And so what happens here is that the drawn credit line backs the deposits of the seller. And so this is a world with short balance sheets because we don't need to have precautionary deposit holdings before the trade. So you see empty balance sheets before the trade. When firms buy goods, for example, when they invest or they buy inputs, they will use credit lines because they have a balance sheet cost. So they don't want to use deposits, they prefer credit lines. And so what happens at the bank level is that there's now a complementarity between deposits and credit lines. And that makes it cheap for banks to handle these payments because deposits and drawn credit lines show up on both sides of the balance sheet, and that shortens balance sheets. So now think about introducing CBDC into this world. What's CBDC? It's a new product in the market for liquidity that is offered by a deposit-only intermediary. The CBDC comes with a new technology. So the central bank has its own balance sheet costs. It's not free for the central bank to introduce it. So it has its own balance sheet cost, kappa star. It has its own maximum leverage ratio, phi star. And let's suppose for the moment that the central bank offers these things at marginal costs. So in the world where banks offer only deposits, then the only thing that matters is whether this technology is better, whether it's cheaper for the central bank to offer deposits compared to commercial banks. What happens if it's cheaper is all depositors switch to CBDC. Banks will go out of business, but because I've assumed that banks are really only good at providing payment instruments, it doesn't matter. This is good for society to introduce CBDC. So that's one case, but this is not the world we live in. We live in the world where we're currently paying with deposits and credit lines. So CBDC is not complementary to credit lines because it's offered by an intermediary who only does deposits. Central banks have not started thinking about offering credit lines. So in this case, it's destroying complementarities. And so then it will only be beneficial if this new technology is really much better. And so that what this mechanism relies on is an externality among liquidity providers. It creates costs for banks in general equilibrium if these if CBDC steps in, and you have the same argument when stable coins get introduced, or you have money market mutual funds. It makes it more costly for banks to handle these payments. When I talk a little bit about market power. So a common argument is that banks have market power in deposits. And so by introducing CBDC, you introduce a product that competes with deposits, and that makes markets more competitive. And so that's a reason why welfare may go up. And so the question is that a good argument for government intervention? I would say not really, because there are many product markets where you have market power by firms. Should the government produce all these goods to provide competition for these firms? I would say no, that's not the role of the government. It's better for just the government to allow for competition from private firms. They will compete away the market power in deposits. So allow for stable coins, allow money market mutual funds or the narrow bank to compete with banks in deposits. More generally, this will interact with other imperfections that we have. And so it's going to be ambiguous for welfare, how we think about introducing CBDC, because banks also have, for example, market power in the loan market. And so then there are papers that show that if you introduce CBDC in a market where banks have market power, not just in deposits, but also in loans, the effects on welfare are highly ambiguous. This is how I think about it.
Thanks so much, Monika. Very clear. Markus, you get to go last, and please go ahead.
Well, thanks a lot, Darrell. It's a pleasure to be part of this panel. And I would like to say a few words, as Ulrich and Monika pointed out. I will go a little bit beyond banks. So traditionally, of course, we have central banks issuing cash to the households and reserves to the banks, and then they're multiplied and issued and inside money to the households. And I would like to extend it a little bit also. The introduction of CBDC will also affect not only the banking sector, but also fintech and platforms. And I think that's important to take into account too, not to have just a narrow banking view. And so what are the big trends? Of course, one big trend is that, as Ulrich pointed out, the physical cash is losing on relevance. So the anchor of the unit of account has to be preserved in order to maintain your loss of monetary sovereignty. There's this whole phenomenon of digital dollarization, or urinization or reminization, whatever you want to call it. So each country, especially small emerging and market economies, are worried to lose their monetary policy power and that can't do any monetary policy anymore. The second trend is that we move really from a bank-centric world to a platform-centric world, where the information gatherings and information advantages are actually not with the banks, but with platforms. And, you know, with abilities with big data, artificial intelligence, machine learning, deep learning, there's a flip in the information advantage. Typically, a customer has the advantage and gets some consumer surplus. That flips. There's, instead of adverse selection, we have inverse selection. And then we have the digital tokens and stable coins and so forth. We have smart contracts and programmable money. And all of these things will really fundamentally change the financial universe. And the question is, where should CBDC come in and what does CBDC do in this world? So first with the banks, and I'll keep this fairly short because Monika was already outlining it, CBDCs will compete with the banks. And that's fine. And the question is, in crisis time, it might undermine financial stability. That's a big concern. CBDCs creates an additional safe haven and depositors can run into CBDCs. And that makes bank runs more likely. And I'm worried about this less so because the central bank can always channel the funds back to the bank. If the bank is solvent, the central bank can channel it back. So I think this worry about the bank running probability increasing is overplayed. I think the bigger worry is if you don't have CBDC, you have a run on your currency. So it's a whole run on your system, especially for small emerging economies. You run out of the system in a different currency, and then it's much harder for the central bank to protect its own financial system. And that when you with CBDC, they run at least into something which stays within your country. And I think that's more important to keep in mind. Now in normal times, that's what Monika was pointing out. Do you want to have CBDCs competing with bank deposits and erode the profit opportunities for private banks? And Monika was very much pushing, there are a lot of synergies between lending and money creation, in particular with credit lines. And, that's essentially CBDC will compete with the private banks and take their profit away. And perhaps you want this profit because there's natural synergies, or you would like to have a franchise value with banks in order to limit the excessive risk taking. They have a franchise value and they don't want to lose it. Or you need the franchise value to stay in the regulatory perimeter. Otherwise, they go outside of everything moves to the shadow banking system. Or you want to have, as a government, this franchise value because you convince the banks to fund your pet projects as politicians, and you would like to have this too. But the question is, why, if you want franchise value for the private banking sector, why should it be granted through market power on the deposit market? Why you can also subsidize it otherwise? Why is the subsidy going through the deposit market? And there's a third argument. You could say, you want essentially the deposits with the banks in order to make bank runs more likely to be act as a disciplinary rule, like a Kalomiris Khan, Diamond Rajan story. But you don't really need them to issue inside money. Just issuing short-term debt is enough. It doesn't need to be money. Short-term debt would be enough to do so. But the bigger thing I would like to emphasize here is essentially what does CBDC do with respect to fintech and platforms? So CBDC will also compete with all the new forms of money and the tokens provided by platforms. And of course, one thing is you have to provide stable coins which are tied and pegged to the, let's say, the dollar or the euro. Then you preserve the uniformity of money. So all the stable coins will not create a separate unit of account, and this way monetary sovereignty is better preserved. But these stable coins are run-prone and require some lender of last resort. So they're pretty much like a bank or a money market fund, and you have to help them out again. Now, if you think about platforms, there are platforms, digital platforms, which improve the matching technology, because on the platform you have better matching. And you also issue some digital tokens. It's a payment technology. And then the whole issue with granting credit through smart contracts come into play as well. And that's, is really going on this modern, and there's modern platforms, and there's an interaction between the matching technology, the digital token with payments, and also new forms of credit. And the question is, should CBDC be then the legal tender for all digital transactions? So whenever you want to pay, you always can pay with CBDC. And there are different forms of interoperability you have to keep in mind. So one argument would be, there's all these platforms, they all want to create their own walls and stay within walls and reduce interoperability to have more platform power and lock people in. And this way, the problem is there's a lock-in in token world, so that if somebody has a token, it's very expensive to swap the token for dollars. You have to pay an exchange, an exit fee, for example. And digital platforms would like to offer their own tokens in order to lock them in the same ecosystem and this way. And if you have some exchange interoperability, you can't do that. And offering CBDC as legal tender would actually help that, because you can always say, you have to accept CBDC as legal tender. So this would actually make the whole platform competition across platforms much more powerful, because on each platform you can use the digital euro or the digital dollar or whatever the digital currency is as legal tender. So that's one argument in favor of CBDC as legal tender. Another argument which goes in the opposite direction is that if you issue tokens on a platform, you can grant credit and you can enforce the payment much more easily, the repayment of the loan or the credit much more easily through smart contracts, like some smart forward contracts. If your future sales revenue, you have to sell it on this platform, and the platform will see the sales revenue come in and they will immediately use it to pay back your loan. So in these platforms, you have this commitment power, which you don't have if the CBDCs are legal tender. So if you sell your product and you can pay, somebody can pay you with CBDC, you can still pay it on the side and the platform will not see it. If it has to be paid with the platform token, the platform will see it. And then, this way you'd automatically, through smart contracts, the credit will be paid back. There's an operability in use. It's a different operability. And this would actually speak for a setting where you don't want to have CBDC as legal tender, because it would undermine this additional commitment power platforms have. And then there's another, if you think about the competition between an existing platform, a potentially entrant platform, where a new platform is coming in and thinks, oh, what will happen? And let's suppose we have private credit tokens and people have credit and loans with this private token. The new entrant can destroy the old platform because it kicks it out. And then actually these creditors that would benefit from destroying the old platform or the incumbent platform. And this way, it actually, if a new platform comes in with new technologies, new token arrangement, new blockchain platform, then actually it would destroy the old platform. And this way, it could actually threaten the incumbent platform to take over and create a lot of havoc this way. And then the old platform is actually paying fees or some bribes, essentially, to make sure that the new entry is not coming in. In this case, it's very distortionary. So you would like to have a setting where there's technological interoperability between the old and the new platform, so the new entrance doesn't have too much threat to come in to kick out the old platform and replacing technology, and this way hurting the old platform at the benefit of the creditors on the old platform. So let me sum up in my few remarks. I think CBDC is very important. It is a cash substitute. Cash is going away. You want to maintain monetary sovereignty. This is very important, probably less important for the US or Europe, but very, very important for emerging economies who are constantly under threat for digital dollarization, or whatever you want to call it. There's some other, the foreign currency moving in, or some private firms currency moving in, like Libra or something. And the question is, do you want to be offensive or defensive? So many emerging economies will be defensive to protect their own monetary sovereignty. You can also be offensive to take over somebody else's country's currency and payment space. But the bigger thing is, do you want access to your own citizens, direct access? Then you need CBDC. And do you want to compete with the banks? And how do you want to compete with the platforms? And with respect to the bank competition, it's a stability issue. So it's a bank versus currency runs. I think if you have CBDCs, I don't think you make bank runs more likely, but it makes it less likely you have a run on your currency. And the question is, why do you want to grant banks market power? And Monika pointed out one aspect of this. But the question is, why do you do it through market power if you want to subsidize somebody? Why not other forms of subsidies or transfers? And then the question is, CBDCs will compete with the platforms and also might enhance the competition across the platforms. And there are three forms of interoperability concepts, which are very important to distinguish.
Markus,
and CBDC as legal tender might destroy some of this. And finally, I would like one more sentence. When we move from a setting we have currently to a new platform-centric financial sector, the transition itself will also come with a lot of financial stability risks.
Thanks, Markus. A great review of the topic. Before I get into, I mean, it would take 2 hours to have a proper discussion of all of these costs and benefits. So I'm gonna pull a fast one on our panelists and then on everyone. you've named a lot of costs and benefits. Central banks are grappling with these right now, and there are different stages. I'd like to know whether you think most major economies will have introduced for general use a CBDC within 10 years, yes or no? I'm going to start with Monika because she's smiling. And are you saying yes or no?
Yes, I
Yes.
think they will introduce it. I think it's as currency is going to go out of circulation, central banks will want to be in that space of providing electronic payments. I think that this idea will sound very good, even if there's pros and cons. I think at the end, the pro argument will win.
Ulrich, I'm going to give you a bit of an out because you're a policymaker and you're not speaking, I'm presuming you're not speaking on behalf of the ECB, but just as a safety so that nobody reports that you're saying the ECB will come out with this. You could restrict your answer to all currency zones other than the Eurozone. Could you answer yes or no? Will most countries have CBDCs within 10 years in common use?
I mean, most not, because 10 years goes very quickly, and this is a big thing, you know. So if you say most in 10 years, that's too strong. But the direction is clear, and some will have it in 10 years, and more will have it in 20 years.
That's good. That's pretty specific considering your position. Markus, your view.
I would agree. I would say the US would move last and might not have it in 10 years. And the reason is twofold. First of all, the financial industry has much bigger sway in the US. and the other aspect is that US is also a global currency, and you don't want to experiment with the major global currency. You see how the others do it and how it plays out, and you learn from their experience and then adopt it later on.